Folks, Business Redefined is in Addis Ababa, Ethiopia. The new flower, I'm told. Fantastic city, great to be here. We are speaking within the context of Africa's youngest stock exchange coming finally into market. There was a history behind it. It did exist, but because of understandable reasons, it then dissipated. But it's coming back sometime later this year. We are privileged to have the Director General of the Capital Markets Authority of Ethiopia, Dr. Brooke Taye. Karibu sana. Thank you.
Karibu
You're
sana.
welcome.
Thank you so much. I really appreciate it.
I keep throwing in my Kiswahili. I'm sorry about it, man. Doc, you're in a very unique position. If you look at many jurisdictions, the way capital markets developed is that the market developed and then the regulator came along with the regulatory framework catching up with the innovation. In Ethiopia, we have the market regulator front-loaded. And one of the things that this could likely do is to create regulatory overreach, which then stifles innovation. How do you intend to navigate this?
Thank you so much, Julius. I really appreciate for this chat. So our unique advantage, obviously, is we're a latecomer, and we can take advantage of understanding what has not worked in many different jurisdictions in the continent. It's not only that we see what has worked and then try to replicate that, but we also look at what has not worked. Ultimately, there is one fundamental issue that we look at when we develop any type of regulatory instrument. An issuer will come to the capital market if it makes sense, if the pricing is right. So how do you make that work? Whenever we design a directive, a regulation, even the proclamation, we put in comparables and we try to understand it. See, okay, what would it require for an issuer to come to the capital market and then raise finance, both on the debt and equity side, versus other markets, the private market or the banks or other alternatives. And based on that, we try to build the necessary caveats so that we'll make it easy for companies to come into the capital market and then, of course, enjoy the opportunities that they have. So that's the most important fundamental issue that we take into consideration. But at the same time, this is something that's unique in our market. And there will be a learning curve. Of course, we'll make mistake, and the most important thing is to recognize that and then correct that. And our legislative process, especially when we issue our rules, we issue it through a directive. That means the authority is empowered to make correction immediately if we see any type of market difficulties that are transpiring as a result of any type of rules and regulations that we put in place. This is how we try to address those concerns.
I see. So from a timeline perspective, where are we as we stand? When should we expect the launch of the market? And how have you gone about laying the underlying infrastructure, intermediaries, the trading system, etc.?
So in terms of the regulatory aspect of it, the Ethiopian Capital Market Authority has been established now for 14 months with management and board appointment. So the important focus area for us for the past 14 months was designing the regulatory instrument, enabling ourselves, hiring experts to work with us, to work in the authority, and doing a market outreach, both on the issuer side and the investor side, to make sure we have a pipeline of products, a pipeline of companies that could be listed. Yeah. And then at the same time also going down to investors and then explaining what the opportunity is, what are the opportunities that will come as a result of our introduction. So that's what we've been working on. At the same time, the exchange has been established as a legal entity. They are finalizing their capital raise. As I'm sure in your couple of days stay in Addis, you've seen the news. Pretty much all the banks are buying equity in the Ethiopian Securities Exchange, which would be a public-private partnership where 25% will be held by the Ethiopian Securities, Ethiopian Investment Holding, our sovereign wealth fund, and 75% will be held by the private ownership. So that's on the process. And as you know, there are three important technological, just to name a few, three important technological acquisition that we need to do. That's the CSD, the monitoring platform, the monitoring system for the authority, and then the automated trading system. So we've concluded the CSD acquisition. Now we are in the process of implementing it, deploying it, both for the corporate and government securities, and we estimate within the next 2 months we can have a live go test scenario. On the ATS and on the monitoring system, on the automated trading system and monitoring software, we've just received very encouraging response from suppliers. 10 global service providers have submitted their tender. We're currently reviewing that. This is a matter of a 2 months process to finalize the procurement and then get into the award, which would allow us to launch the exchange as we've indicated in 2024.
When you talk about building a pipeline of issuances of companies that then come to market, within the global context, and more so in Africa, over the last decade, we have seen the decrease in the popularity of going public.
Yeah.
If you look at about 2014-15, there were about 35 IPOs in Africa. Currently, we are playing in a very small, the low tens. And the question is, how then do you create a framework whereby companies actually see the value proposition of going public in an environment where private markets, VC, private equity, etc., have really caught on?
So I think it goes back to your first question as well. If the regulatory exercise is expensive, nobody's going to come to listing. So one of the areas that the way we're creating our market is we're focusing on making sure our regulatory instruments do not hinder companies to become public. So that's the most important area we're working on. But second, necessity. What is the alternative for most companies in Ethiopia? Going to the bank or not having access to any type of capital. So the fact that there is not that many VCs or private market that provides the necessary financing for expansion, acquisition and whatnot, the capital market becomes a wonderful proposition. But at the same time, more than listing, what we're looking at is, look, capital markets are a creation of two different instruments, right? On the debt side and the equity side. The exciting aspect of equity market, IPOs and listings are always at the forefront. But we have to look at also the debt market. Yeah. It is such an important part of the capital market ecosystem, both for implementing your fiscal policy and monetary policy, but at the same time enabling companies to access the debt market through corporate debt instruments. So even though the listing exercise has not been a success in the past 2-3 years throughout the continent, but if you look at the debt market, in Kenya, for example, it's viable. I was looking at your publication a couple of days ago, and I was seeing that the retail investor has grown from 11.2% to 11.5% in the debt market, especially on government instruments, versus institutional investors, which is encouraging. Because this is a way of contributing to reduce monetary and fiscal policy pressures on the government and relying on your domestic savers to help you navigate this challenging macro environment globally. So we are not only looking at the exciting listing opportunities, but also the debt market. But being specific on the pipeline, we're going to issue the first primary offering would be Ethio Telecom, the 10% Ethio Telecom listing. We are reviewing their prospectus. We've received their prospectus and we're currently reviewing that. And there are 5 other state-owned enterprises which we've done their IPO readiness. It's very encouraging, and we're in discussion with the Ethiopian Investment Holding, the sovereign wealth fund of Ethiopia, to see who owns Ethiopian Airlines, Ethio Telecom, and all of them, to see if they have any interest of issuing, listing some of them. There are also privately held companies. Who want to come to the market. We have 30 banks and 18 insurance companies, all owned by domestic investors, to the tune of 400 retail investors, 400,000 retail investors own these banks. Technically, they are publicly held companies, so they can do listing by introduction. And so you can do the math, the volume and the size of the listing prospect of the Ethiopian Securities Exchange is significant. And this is without considering on the fixed income side, municipality bonds, sukuk bonds, and green bonds that we're working on already. So we're excited. Of course, there will be challenges along the way that we have to learn, but it will be an exciting opportunity.
Allow me to drill down further to a more specific question. It looks like the debut corporate action will be an equity raise. Or will it be a fixed income debt raise?
So when the market becomes operational, the exchange, when we ring the bell, it probably would be a fixed income instrument being listed.
Okay.
But on the primary market side, I think the first issuance would be on equity side, and I think it would be the Ethio Telecom 10%. Before that, I don't see any other prospect. So I think on the equity side, it would be a capital raise, and it would be our hope and wish is that it would be Ethio Telecom.
I thought the airline would be a good candidate.
So all of them are a good candidate, and I think the airline, I mean, they can use both debt and equity instruments. As you know, the government owned 100%, so it's up to the government to make a decision. If the government decides they wants to make a certain offering, then it's up to the government. But as far as we're concerned, we will welcome both government-owned and private-owned companies to have access to this vast opportunity in Ethiopia, not only the retail and institutional investors of Ethiopia, but also our regional partners and global players as well.
When you talk about fixed income, we are in an environment where, to the best of my knowledge, you correct me if I'm wrong, we don't have a yield curve.
Yeah.
How do you intend to go about the pricing of instruments?
So I think we will leave the pricing to the market. What do I mean? Right now, if you would go to a bank in Ethiopia and try to raise any type of debt finance, it would cost you in the north of 20%. This is if you're went through the whole process of justifying your business. It's been accepted by the credit committee and whatnot, and then you will be required a significant amount of collateral. So companies and businesses are going to the debt market through the banks and accessing capital, paying 20% and above. And my saving account with the private banks and the government bank is yielding around 7%, and I'll pay tax on that as well. Yeah. So the delta between the two, my saving rate and what the companies are paying,
is wide.
It's so wide.
Yeah.
So for me, anything plus what I get in my saving rate, I'll buy a debt instrument because I wanted to actually get that 1% alpha, whatever that is. For a business, if it is anything less than 20%, you will be interested, obviously, to go to a debt market where somebody will be willing to buy your instrument and paying and is requiring you to pay anything less than what you're paying to the banks. So that's what I mean. The market will find that sweet spot for each debt instrument type. If Ethio Telecom or Ethiopian Airlines comes in with a significant amount of volume of debt instrument, of course, the backing of the state, and then the fact that these are, companies with a significant amount of revenue potential and growth potential, of course, their yield will be, or their coupon rate would be much lower. But if it's a new company, then it would be a different case. But for the yield curve will be something that will be defined when we start relaxing the government policies that are also impacting the non-formation of a yield curve in the marketplace. And this is the process that the government is currently going through in terms of liberalizing sectors and removing repressionary measures in the financial sector. So then, of course, the yield curve by itself will transpire. But until then, I'm very confident the market will find a specific rate for a specific product, and that would allow the market to start growing.
Do we have any visibility of the plan to retire the mandatory uptake of debt issuance by the government by commercial banks and the commencement of issuance of benchmark bonds? Because that is then what will help us find this yield curve.
So let's look at this from a wider macro context. The government is in the process of right now introducing a second version of the homegrown economic reform, a 3-year program that allows several liberalization and reform in many different sectors. One part of that is the macro reform that looks into our debt issue, our unemployment issue, our foreign currency related issue, and then our major problem, which is inflation. Yeah. So we're working on these 4 aspects under the homegrown economic reform, and which is the macro reform is a subset of that. And in order to resolve some of the issues that you've raised in terms of removing some of the repressionary measures, we're working with several partners, including the fund and other partners, to find a mechanism to fund some of the gap that will transpire, the cost that the government will incur as a result of this type of exercise. But we're not looking at it only in isolation, but at more of a global view of what is not working in Ethiopian macro climate and how do we resolve it one step at a time. But the outlook, which we've committed in 2019 when the homegrown economic reform 1.0 was introduced, and the government still committed to, is trying to make sure that more private sector involvement in the economy, remove any barriers self-induced by the private sector and then government-induced most of the time, remove that to allow the private sector have a seat and be in the driver's seat to make sure the economy performs and achieve its potential. Yeah. So that's the broader policy mindset that we're working on. Every day there are challenges that we have to overcome, and for your immediate need, you may introduce certain measures, repressionary measures. But when you look at it holistically, we're heading towards the right direction, which is a market-based system, both on that resolve the macro problem, but also the immediate issues of private sector issues.
Doctor, you ventured into the macros, and allow me to nudge you a bit on that. Yeah. The plan for going public with the capital markets is coming at a very interesting time when, of course, the conversation around Ethiopia's obligations to external creditors is quite a hot topic. There was a coupon payment which was not made. There has been a debate. Is it a default? Is it not? And what does this mean for what you're doing currently?
It means, first, our primary audience is our own constituency. We do any type of policy based on what's right, what's important, what's vital for Ethiopia. So there are a lot of noises, of course, the default, the deferred payment and others. Ethiopia shouldn't have done this. What would be, how would the foreign direct investors will look at Ethiopia? But the way we look at it is, if it works for Ethiopia, we'll do it. It's as simple as that. That's first. Second, the reason why it's done is we do not have a tendency or a preference to leave a time bomb of a debt burden to the next generation. If we have to deal with it, we deal with it now.
You don't kick the can down the road?
No, we don't kick the can away. This government has not borrowed a single dollar for the past 5 years. We went through an excruciating war. We went through COVID. The whole globe is going through a very difficult macro situation. Commodity prices going off the roof. Even with all of that challenges, we have not borrowed a single dollar. A single dollar. That is a commitment of a government who decided we're not going to push the can to the next generation. Unfortunately, we are stuck with this debt burden. We resolve it. We will leave a better macro environment for the next generation. So that's the preamble of the entire debt discussion. So what we've done, 2018, 2019, 2020, and 2021, we worked with our bilateral partners, especially the People's Republic of China. They were gracious enough to provide us the necessary relief because of our liquidity constraints. First, on a bilateral discussion. Second, 3 programs with the Debt Sustainability Initiative as a result of COVID, and then now with the view that because of the serious liquidity constraint that transpired because of commodity price spikes, they provided us over $1 billion reprofiling of our debt until 2024. With that analysis, we also went to the G20 Common Framework, and a significant number of our bilateral creditors under the auspices of the Paris Club, they provided us the necessary privileges to defer some of the payment. That's the same principle that we took to our bondholders. Of course, they have a different view, and we couldn't agree on that particular time, and then we decided to defer the payment. But I'm very confident that there will be a resolution to this, and we're engaging with them as we speak. There's a live conversation and discussion. But we don't make this type of decisions very lightly. The government did not make this type of decision very lightly.
Yeah.
We are committed to honor any type of our obligation, but there are principles. You treat all your creditors equally. You have
in a restructuring process.
Yeah, in the restructuring process, nobody comes ahead of the line. And there is a reason why we've asked for this reprofiling. So we will, with under the discussion of the common framework, of course, there is a debt sustainability analysis that needs to be done. That will yield a certain number that we have to find a way to resolve that. And we're managing, we're handling it. And our debt to GDP ratio has reduced from 53% a few years ago to now around 48%. And we made over $9 billion payments in the past 4 years. It's not, it's $33 million is not a huge amount of money for Ethiopia.
The more the reason we were surprised. But Dr. Brook, to counter your narrative, you and I know, Doc,
yeah.
A debt restructuring process, not all creditors are equal.
Yeah.
We have the preferential creditors who are spared a haircut. Those are the multilateral. Then the question becomes, don't you think the action that was taken, and maybe just to digress briefly, has serious implications on where you are going now with the capital markets? Because a foreign investor will sit back and wonder, if I poured my dollars into this market, do I have certainty around the course of action that will be taken?
So, as I've said, we're not specifically privileging any creditor. They will get all the privileges that is stipulated on any credit facility. So, based on that, everybody is equal for us. So, when I say that every creditor is equal to the extent of the credit facility that we've agreed.
Yeah.
So, that's the intent of my statement. But second, as you said, from what we're doing, look, initially we're focusing on our domestic market. So if there are foreign investors coming in and wishing to participate, of course we would welcome them. But any foreign investor coming into Ethiopia, they're not coming in for a short term. They need to have a long view, and most of them have a long view. When Safaricom invested $850 million with the consortium and additional $150 million for the mobile financial services, and in total $1 billion investment of a huge consortium, they're not looking at it from a 2-3 year short-term point of view. They're looking at the long term, the long view. They know the huge value trap in this country that they will be able to benefit if they stick with us. So we expect a similar type of investors to come in. But from the capital market point of view, first we look at the domestic investors, and then we try to develop the market relying on that. And then gradually, of course, this will be a very dynamic and international market. That's what we hope.
A number of securities exchanges in Africa are largely dominated by foreign investors. And what that means is that in the event of global macros going haywire, then the transmission effect here is felt significantly. It sounds to me like that's one thing you want to sidestep. How do you intend to do that?
We will bank on our domestic retail investors to make sure that the market is dominated by retail investors, because we've seen it already on the banking sector. I gave you the number earlier. The 30 banks and the 18 insurance companies, all owned by domestic retail investors with a maximum position of 2%. They're not even allowed to have more than 2% and not more than 5% overall ownership of in any banking or insurance sector. So we have the scale that to really bank on our retail investors to have that opportunity. But we have also a very huge and large pension fund that's primed for a reform and went through a reform, has a new mandate now to aggressively get into an investment cycle. We will develop a collective investment scheme that we would hope help us to aggregate a fragmented retail investor investment and then put it into the capital market and act as asset management companies would do in other parts of the world, and we rely on that. But this denies the fact that we will need foreign investors to come in. This is an opportunity and it's open for everyone, but our primary target will not be how do we develop a capital market so that it attracts a foreign market participants. Our first priority, our constituency is a domestic market participant. We will build the market based on that. And if there is any interest from international investors to come and participate, by all means, we'll be very happy to incorporate them. And also, we're lucky also to have over 3 million, 4 million diaspora across the globe, who are always attached to their country and they wanted to contribute their part. And they already do it through their remittance. They already do it coming here and investing in businesses. And now they're going to have a very easy and comfortable opportunity for them to participate in our market.
Have you received any appetite from intermediaries across this continent in coming into Ethiopia? And I'm particularly interested in those from the Kenyan market.
Absolutely. So that's a very good question. I think, let me maybe go back a little bit and explain to you how we look at when we design our regulatory instruments. Even in my days at Ministry of Finance, whenever we look at policies, whenever we look at new initiatives, the first place that we look at is the Kenyan market. One, of course, it's our proximity. And it's very easy for us to understand what worked, what did not work in the Kenyan market ecosystem. And when the market opens up, and we were justified with the coming of Safaricom as well, that our brothers and sisters in Kenya will be the first one to take advantage of this opportunity. So when we designed our intermediary legal instruments, we're looking at Kenyan companies coming in and setting up shop in Ethiopia. So I'm very happy to tell you one of the first applications that we received is from an institution that's based out of Nairobi. We're going through their application process. I wish I can tell you their name, but obviously it's confidential. But we will make an announcement very soon. It's in
the investment banking space?
It's an investment advisory. But this is an open call for all your viewers who are interested to work as brokers, securities dealers, investment bank, investment advisors, credit rating agencies. This is where they will have a huge potential to grow. The market is large. There is a huge interest to learn and to exercise their skill. So this is an open invitation for all of them to come and set up shop. Because whenever we look at the market growing, the Kenyan intermediaries are at the nucleus of it. And helping us to craft a successful capital market intermediary business in Ethiopia.
Okay. To piggyback on that point, when you scan the continent, whether you're looking at Casablanca Exchange, Johannesburg, Kenya, Egypt's exchange, what are some of the lessons you have learned about what not to do in capital market development versus what to do as well?
Okay, I'll tell you what. I will tell you what we've learned in terms of what to do and being specific as to the location. But I won't say where we learn what not to do, because most of the regulators we interact with, I don't want to piss them off. So in terms of what we learned in terms of what to do right, first is Casablanca and the entire Moroccan exchange, Moroccan capital market ecosystem. The way they've done it in the debt market space and the growth of the asset management companies and their contribution to government debt finance and capital raise exercise. And then now they're specializing even on securitizing financial instrument. This is something that we want to replicate here. It relies heavily on their own domestic investors, institutional of course, but retail investors and diaspora Moroccan investors are also participating. That is something that we really wanted to take into consideration. And also the Kenyan ecosystem, what we're looking at currently with the Treasury issuing infrastructure bonds and then being some of them being oversubscribed, and the Sukuk bond, Islamic compliant bonds that were successful in Kenya, we want to replicate that as well. And Nigeria is a very interesting case. Of course, there are some volatility that happens in the market. But if you look at FMDQ and how it managed to create a very successful ecosystem to allow the debt market portion of it to succeed, is something that we wanted to replicate and we want to learn. How not to do it in most of the jurisdictions that we've seen is on the equity market.
Yeah.
There are excessive regulations. It's expensive for companies to come and list it. You have to balance regulation with risk. As a regulator, we're also taking a risk. You know, there's no certainty as to a company that's coming and listed to not perform any type of yield because it's very difficult to know the future. Yeah. So there's a certain level of risk appetite from the regulator as well, because you can't know everything when you register their securities. And I think there needs to be introspection with most regulators in the continent on the equity side as well. Why are not our companies being listed? The minute that they become a unicorn, why do they run to LSE? Why do they run to New York? We have to start investigating that, because the foreign investors also would want to invest regardless of where the location is to a certain extent. And then you need to encourage the market capitalization will dissipate when you start losing your unicorns being listed in other parts of the world. But of course, there are more to be done. And the good thing as well is now with mobile trading facilities growing, that's allowing significant number of retail investors coming into the market. That also provides further benefit.
Okay. Doc, it sounds to me like your model, based on the comments you've just made, will be almost a hybrid model. By hybrid, I mean that you will have the fixed income running almost as an independent exchange, as we have in Nigeria, the Nigeria Exchange and the FMDQ, versus what we have with the stock exchange. Currently, Kenya is also navigating the same change. Yeah. Is that a correct assessment?
No, it's actually the reverse. So we're going to have a consolidated OTC debt market, equity market under the Ethiopian Securities Exchange umbrella. So it will be one exchange, and because the market has to grow, and then we have to define if that would be a necessary way to split the debt market from the equity market. What we have, as you know, we have a commodity market that's separate and apart. But on the equity and debt market, it will be a consolidated under the exchange, the Ethiopian Securities Exchange auspices. But our regulatory approach will look at both in a very separate way and learning from jurisdictions who've done it right, who've done it correctly, and trying to incorporate that into our legal instruments.
Your focus sounds like it will be extremely retail skewed. And the challenge that normally emerges with retail focus is investor sophistication. One is because of their own level of protection and appreciation of risk and reward. Yeah. And secondly is the fact that you might have very robust product development, but product uptake becomes a problem. Yeah. How do you address those?
So we've seen already our retail investors successfully created 30 strong banks, 18 strong insurance institutions in Ethiopia. We've seen our retail investors taking part in many different ventures, and we wanted to capitalize that. We wanted to make sure that how do I spend much time making sure my retail investors are aware they have access, and they can utilize this capital market system to finance to as an investment vehicle. It's also a democratization process of access to finance. An institutional investor, ultimately they have all the opportunities to invest their money anywhere else they want. So if you're serious about financial inclusion, the way to democratize access to finance and the way to democratize investment is by relying on your retail investors. You cannot disregard your retail investors and try to grow an inclusive. You may grow a very elite-based capital market, which we do not intend to do, by the way. We have zero interest. What we wanted to do is to create a very inclusive, domestic-based, that would allow everyone to be part of the growth and success of companies in Ethiopia, every one of us. So that's the ambition. Yes, it's going to be very challenging, but I have full confidence because, without a regulator, without anybody sitting there and then managing, reviewing prospectus, retail investors have channeled significant amount of billions in many different businesses. Now, a regulator is coming in and even giving them more confidence, more protection. So I'm sure that they will be able to have access to this. And, the success of Ethio Telecom Telebirr, which is the M-Pesa comparable. 3 years ago, they had 0 users. Right now, they're sitting with 45 million users on Telebirr. So Telebirr could be a wonderful opportunity for them to have, for retail investors to have access to the capital market. In fact, I took part in the investor event of Safaricom, and the challenge, what I challenged the team is, M-Pesa is an innovation of the early 2000s. You need to come up the same way you've made the entire continent proud with your innovation of M-Pesa. You need to come up with a new innovation for financial inclusion with investment, and that's what's expected of a team for the caliber that they have. Yeah. So we think that the fact that we're going to have mobile financial products giving access to a lot of retail investors, and then that would allow the retail investors to have access to the capital market.
Okay. As we dial down our conversation, Doc, one is, are you banking on any fiscal incentives from the government to sweeten going to market, whether it's a tax incentive on the corporate income tax for a listed company or such kind of an arrangement?
So it's as if that you're privy to my lunch conversation with the finance minister this lunchtime. So yes, we are. In fact, we've finalized this tax incentives, and we have a couple of meetings next week to finalize, how they would be structured and where they would be put into in terms of a couple of legislative instruments that are going through cabinet in the next few weeks. But there's a huge commitment across the board in government to support us, and some of it obviously to make sure that you have zero tax on government bond or government data instrument, but you have tax on corporate bond. This is not something that would work. So we wanted to really remove this type of barriers across the board to allow the market to grow, and then we can come back to them in the future to see if there are areas where the government needs to take its fair share of the economic activity. But at this point, very happy to tell you, we've agreed with Ministry of Finance on substantive tax-related incentives by way of a reform, by way of removing some of the issues that it was identified by our team would be an impediment to the system to develop.
Okay, brilliant then. Do you intend to stratify listing requirements? And why I'm asking that question is because in markets like Kenya, Nigeria, it emerged that the Securities Exchange was left for the elite companies.
Yeah.
Medium-sized and small businesses just didn't see why they were going through the hustle of all the listing requirements. And therefore, for example, if you come to Kenya, 10 years ago, there was a development of the growth enterprise market segment to try and catalyze the coming to market of such entities.
In Ethiopia, one of the things that's very unique, when I talk to my counterparts in other jurisdictions, we think that we're crazy, but it worked. It worked, and we're going to continue doing it. What is that? We will allow even companies under formation to be able to go to the public to raise capital. We're not going to require them to have to be in business for 3 years, to be in business for 5 years, to be listed. Our commercial code has a provision that we've adopted into our public offer rules, which is if a company comes in and puts in a prospectus a forward-looking plan and stipulates all the risks, it's up to the investor to make that decision, either to give him money by way of an investment or not. It's not up to us to be a gatekeeper of potential growth. We want to transform our public offer directive into a VC type of structure where there would be a lot of investments. Some would fail, some would succeed, but who are we to know the success and failure of businesses? We work for the government. That's not our role. Our role is to remove barriers and to allow companies to be formed and to be financed. So what we've incorporated in our public offer directive is to allow nascent companies, startups, companies with only the idea, if they can come and provide us all the necessary requirement on our public offer directive and fulfill what's stated on the commercial code, they will have access to 120 million people to back their business. That's the best way of committing to grow your economy, to grow a domestic sector that would not necessarily need to look at finance only from one source, which is a bank. So that's the way we're going to remove that challenge.
Doc, allow me to be the devil's advocate here. I see a challenge there.
Yeah.
Because the reason why global practice is that an investment memorandum will have 5-year historicals is because you want to see the track record of the business.
Yeah.
And the reason why, if you go to the private markets, the VCs, the PEs have appetite for business solely on their story, not necessarily on their historicals, is because they squeeze maximum return out for the risk they're taking.
Yeah.
An ordinary retail investor in Ethiopia, in Kenya, in South Africa, doesn't have that level of, one, skin in the game to take on that risk, two, sophistication to understand what they're getting into.
So that's the level of allowing, and that's our role to make sure that on the prospectus, on the public offer directive, as stipulated on the public offer directive, to be stipulated all the risks that are associated with this business. Now, if the company cannot justify or put all the necessary information on this offer documents, of course we're not going to authorize it. But we're not going to make a decision if it's going to be successful or not. That will be left to an investor. So we have a much, I would say, higher appreciation to the sophistication of our retail investors because we've seen it already in terms of where they put their money. But at the same time, it's a risk worth taking to make sure we democratize access to finance to companies. If the worst comes worse, a company that raises billions and billions of birr from millions of investors, a small amount, that loss is bearable to an individual investor versus a risk that we could take of not allowing a potentially Uber idea that could come into the market because we think that maybe this company has to justify itself and be in business for 5 years. And then this is an environment where we do not have VCs, we do not have the private market that's to take, to be able to say, no, we will wait. They won't grow.
Yeah.
So we want the retail investors to take risk, measure risk based on the documents that we provide them. And if that risk of failure materializes, we will take a position in terms of what we require on the prospectus to reduce that having a systemic risk. We work in that environment. But ultimately, it's a risk reward. It's an investment ultimately. Our place should be how do we allow as many companies to go to the market and have access to finance, where in an environment where there is no access to finance for most of them. you know, what has been tried for the past 25 years. All these development finance institutions, World Bank, IFC, everyone tried to come up with, tell us, okay, this is how Kenya needs to, introduce to have access to finance for everyone. This is, maybe we need to try something different. Maybe we need to trust our own retail investors and allow them access to take risk, you know. So that's how we're going to approach it.
Okay. A lot of exchanges in the continent right now have taken on the structure where they have an incubation vehicle on the side, whether they're called sandboxes or whatever it is. Do we have a similar structure here?
Yes, we've just launched a regulatory sandbox in collaboration with the National Bank of Ethiopia, the United Nations Development Program, and ourselves. We've hired a company that developed a regulatory sandbox, or people who used to work for the regulatory sandbox idea of the FCA and the UK, and they've just started their operation. So we're going to throw them ideas, we're going to throw them issues to resolve. This idea that we just talked about in terms of allowing companies under formation and coming into the market and raising capital, what would be the risk, what would be the risk for the retail investors, how can we protect them, what's the best way to access that. All of those ideas will be thrown at them so that they can work with the market and then find ways to cure any type of issues out there. But regulatory sandbox is very important because you learn to regulate. There are new ideas. The market is always one step ahead of you. The minute that most regulators in the continent and most people in government understand that the market is more sophisticated than us, especially African markets, because we survive and they survive in the most challenging environment. Yes. I mean, you've looked at our businesses. I mean, the entire challenge that they have to go through and then make money. I want to learn from them.
I see.
So we have the regulatory sandbox. Would work with these investors, with the market, and then channel those ideas to us, to the central bank, and then of course UNDP has a broader support program that would allow us to work with them.
Two final questions. The first one is this. In many nascent markets, like Ethiopia is right now, one of the high risks is market manipulation. Because of course there's information asymmetry.
Yeah.
How prepared are you for that?
Look, so that's, if anything that keeps me up at night is that. Because you need to get it right, something unique to the market, you know, information, the value of information, and how it would have an impact on price. Since that has not something been regulated, there needs to be a change of behavior. But we have to be ready for that. So we're trying to address this issue in two ways. One is we've created a regulatory task force, intergovernmental task force, with Ministry of Justice, the Federal Police, the Financial Intelligence Unit, and Ministry of Trade and ourselves to start working on right now, in order to have a very efficient way to identify, investigate, and bring to justice any type of market abuse exercise. So there will be zero tolerance for market abuse, zero tolerance. We will bring the entire might of the federal government on anyone that does any type of market abuse. We will not allow the market to be manipulated by individuals who have prior access to any type of information. So the Minister of Justice, when we launched this project, clearly indicated this sentiment. The Federal Police, the Commissioner, indicated the sentiment, and the Financial Intelligence Unit was tasked with identifying any type of money laundering and any illegal financing activities, indicated that as well, and then we'll work with them. Second is technology, because everything is recorded. We have time. In terms of the trade, an individual might do any type of market abuse or insider trading today, but we'll have time, we'll investigate, because we will have a record of that activity. And third, which obviously this is your and your colleagues' role in the media, is most of this type of stuff could be mitigated with the support of the media. So we're working with the media aggressively to have a training to make sure they understand any type of rumors that may end up resulting in market abuse, and really to do a wonderful work of identifying this type of issues and bringing it to the authorities so that we can take action. But this is one of the things that I'm really concerned, and I really work with my colleagues really hard to make sure that we try to be, if not ahead of the curve, at least at the curve, and waiting for this type of stuff to happen and then take the necessary corrective actions.
Okay, now final one. I'm really intrigued by a securities exchange framework where the government is actually a shareholder. Because the idea behind securities exchanges is that market participants basically are the shareholders, so to say. Maybe you could give us some thinking around this.
Yeah. So this is, the current administration is a very pragmatic administration. And in many of the works that the government has done, I think it's shown. We look at what could work without putting ourselves in any type of framework, saying, oh, this needs to be done by the private sector or this needs to be done by the government. What works? Who has the capacity to do it? And when the exchange was established, a huge amount of money has to be spent in terms of getting it ready. But on the founding proclamation, on our founding legislative instrument, it clearly stipulates the government will only hold 25% and the rest will be for a private sector as long as there is a private sector interest. Lo and behold, now there's a private sector interest. We're divesting our interest there.
Yeah.
In most of our decision making process in the economy especially, it's a pragmatic approach. What works for Ethiopia? If it works for Ethiopia, regardless of the noise, we'll be able to do it. One of the things that will be subjugated to a huge volume of criticism, because I was also very involved in the liberalization process of the telecom sector. Why would you not allow the bidders of the spectrum license and the telecom bid to have mobile financial services? And we said, why? It's a different asset class.
Yeah.
We are not going to merge it into a telecom license and then lose a huge amount of volume. And we ended up generating $150 million for Ethiopia. Because we were pragmatic, and the number of letters that we received from every friend and foe was from here to Timbuktu.
Yeah.
But what works for Ethiopia, we'll do it. So our economic reform program also is like that. So we're stepping in, we're trying to facilitate. If the private sector uptick is there, the government will focus on other aspects. And this is the overall kind of mindset and psyche of this administration in terms of introducing new rules and procedures and investments and the creation of the Ethiopian Investment Holding, what the government is investing in many different projects. On the energy sector, for example, it's even, we were being lectured that Ethiopia does not need the Grand Ethiopian Renaissance Dam. Now it's benefiting not only Ethiopia, our Kenyan brothers, our Kenyan sisters. So this is the overall picture that we look at it.
We've spoken for a while, Doc. What's your parting shot?
Well, so this is going to be a very exciting market, and as I was explaining to you earlier, we would really appreciate and would be excited to have participation from regional players. Companies in Rwanda, companies in Uganda, companies in Kenya who've done this and have led their capital market sector development. So it's an invitation to especially market participants, intermediaries, the investment banks and others to come and have a look at the opportunity in Ethiopia. We had you in mind when we designed this rules and procedures, and there is a natural complement. The only competition that we have between us is on the 3,000, 5,000 and 10,000 and a marathon. Other than that, it's always that complementarity between the two countries, and I hope that we have more investment coming in from Kenya to take part in the capital market of Ethiopia.
Dr. Brook, thank you so much for your time.
It's a pleasure. Thanks for
Truly
having me.
appreciated your insights.
It's a pleasure. Thank you.